Another day, another loss for stocks. The markets are falling and they have company in commodities. As the terms risk on and risk off come back to the market, the Dow and the Nasdaq are now down on the month. Hello to you out there on your laptops and your iPads, and welcome to Futures Now. I'm Jackie DeAngelis. Today we are joined by Anthony Grisanti and Jim Urio and our special guest, Peter Schiff of Euro Pacific Capital and the author of The Real Crash, America's Coming Bankruptcy. And as the title suggests, it's a real upbeat read. Peter, great to have you with us again.
Thanks for having me back.
All right, listen, let's get right into it. Let's start with gold. You've told us that gold is going to 5,000. You've also told us that, quote, gold has only one direction to go, and that is higher. So why has it been one of the worst trades this year?
Well, I never said it wouldn't be a bumpy road. You know, a lot of people don't understand the fundamentals behind the gold market. They don't understand why it's been rallying for now, 13 years since this bull market began. And this is not the first correction. We've had many corrections, and a lot of people have been scared out of the market, but then the market goes on and makes new highs. I think there are more reasons than ever to buy gold. I think the fundamental case for gold is as strong as it's ever been. And I think despite this recent pullback, the technical case is good. In fact, now you have a better short-term opportunity in gold because I think you've got a good trade now just buying gold because of this decline.
Hey, Peter, it's Anthony in New York. If the U.S. stops or scales back the QE program, what's the catalyst that will take gold higher?
Well, they're not going to scale back QE. If anything, they're going to increase the size of the QE. You know, the only thing that maintains the illusion of recovery is QE. If the Fed were to stop, we'd be right back in recession. Now, it should stop because, unfortunately, the economy is so badly damaged by all this cheap money that we need a recession to fix it. But the Federal Reserve doesn't care about that. All they want to do is try to ease the short-term pain. And so the only way they can do that is to print larger and larger quantities of money. So they're going to up the size of the QE. They're not going to pare it back. They cannot exit. And so this is very good for gold. Central banks are trying to debase their currencies. It's a currency war. And the only real winner in a currency war is gold.
Peter, this is Jim in Chicago. Quick question. When the Fed says something like they did yesterday and when they did a month and a half ago, where it almost sounds like they're being responsible, is that 100% just a trial balloon to see how risk assets will handle it, or do they have any intention of being responsible at any moment?
No, absolutely none. I mean, there might be some voices of dissent at the Fed, and they're going to be silenced. And, of course, people are going to worry about the negative long-term consequences of what they're doing, just like maybe a drug addict occasionally worries about the negative consequences of doing heroin. But he doesn't care because it feels good to do the heroin right now. And that's all the Fed cares about, is how do we make the economy feel good? We're going to numb it up with all this monetary heroin. We're going to try to artificially prop up the real estate market, the stock market. We're going to try to prop up the government so it doesn't have to default. We can help it monetize its debts and inflate them away. So it doesn't matter what the Fed says. All I care about is what the Fed does. And they're going to keep doing what they've been doing, which is printing money.
Okay, so your view is that they were just sort of testing the waters there, but they're not really going to pull the trigger and pull back on the quantitative easing. Well, Peter Schiff, you're our bull. Meet our gold bear. Joining us now is Credit Suisse's head of precious metals research, Tom Kendall. Tom, glad to have you on.
Hi, it's a pleasure.
All right, look, I know Peter's going to be dying to get in here, but I want to start it off because in your note that you say that the gold rally has been a byproduct of some of the fear that we've seen in the Eurozone collapse, and that fear is in the past. But if you look at the European stock market today, if you look at the euro today, that fear very much in the present. So why are investors selling gold?
Yeah, well, gold has had a very good run, as Peter said, and we've come out of this period over the last 3 or 4 years where people have felt really concerned about equities, about housing, about governments, about currencies, and now we're not saying everything in the garden is rosy, but it's looking sufficiently better to investors than it did 12 months ago or 18 months ago for them to start considering putting less of their capital into defensive assets like gold and treasuries and putting more of it to work into something that gives them a yield. And that's what we've been seeing so far this year.
Yeah, well, if you think about it, though, gold doesn't need a political crisis to shine. As a matter of fact, if you go back to 2000 to 2008, before the Eurozone crisis, before the 2008 financial crisis, gold did better in that environment. Stocks were going up, but gold was going up even faster. So So why do you think you need to have a political crisis? It's a monetary crisis. There's too much inflation. There's too much money printing. That's what's been driving the gold rally, not the Eurozone.
I'm sorry, the inflation point I don't get, because there is no inflation in the developed world. What the central banks are trying to do is to do everything in their power to avoid deflation. There is no inflation pressure either.
There's
in
plenty of inflation. The government doesn't want to acknowledge it, but prices are rising. Consumer prices are going up. Money supplies are expanding. That's the definition of inflation. You can see the inflation in the bond markets. You have bond bubbles. You have housing bubbles. Look what's going on in the world. Interest rates are too low. There's too much money creation. That's inflation. That has to stop. But the central banks are afraid to let it stop because they don't want to allow the economies to restructure.
Well, I think there's not enough people who any longer agree with that view. That's the problem for the gold market right now. You've seen a very bearish reaction in the gold market over the last week or so, and just the minutes from yesterday from the FOMC meeting in January, where you had minutes outlining the fact that FOMC members are discussing the potential for scaling back QE sometime down the line. Just that potential discussion has taken.
They've been discussing that for years. It's all a bluff. It's all bark and no bite. I mean, they've checked into the Roach Motel of monetary policy. They can never withdraw the stimulus. It's all a bluff.
You're saying the stimulus can never be withdrawn, and we're on this QE track indefinitely, way into the future.
Well, not indefinitely. It's going to end when there's a crisis, when there's a currency crisis, when the dollar implodes, when we have a sovereign debt crisis. That's what's going to bring the party to an end. But the Federal Reserve is never going to act preemptively to take away that punch bowl. They're afraid to do that. So they're going to push the envelope as far as they can.
Peter, when does that happen?
I don't know the exact date, but I think every day we get closer to it.
But do you think that that's something that could happen this year, next year, more in the short term, or are we talking about continuing this policy?
It could happen tomorrow. You know, I don't know. I mean, we're living literally on borrowed time. I think we've already gone on longer than it should have. But eventually it's going to come to an end. And you can see, you know, all the problems around the world that are resulting from this monetary policy. And eventually it's going to culminate in a dollar crisis. But until then, it's going to be business as usual at the Fed. But they can't let on that the only thing standing between us and implosion is their quantitative easings. They want people to think that we have a viable economy. So they discuss the possibility of removing the training wheels, even though they know they can't remove them because QE isn't the training wheels. They're the only wheels. If you take the wheels off, the bike's going to fall over.
Tom, your response to that?
Well, I don't know. I'm not quite sure which currency the dollar is going to implode against. It certainly doesn't look like it's imploding against the yen or the euro. You know, at some point in the future, down the track, the unintended consequences of today's monetary policy may indeed come back to hurt investors through inflation, through some kind of currency crisis, through some kind of other debt crisis. But I think the issue is that in the interim, and I think that potential crisis, if it happens, is a considerable way down the track. In the interim, things are looking better. You know, the U.S. housing market is picking up. It's picking up from a very low point, for sure, but it's picking up. Equity markets have done reasonably well so far this year. They're pausing now, but it's looking better. And, you know, when things are looking better, gold goes down.
Peter, why is that part of the problem?
Because housing prices are still too high. We're still diverting too many resources to propping up the housing market. We should be building factories, not houses. The government is trying to reflate that bubble. This is just, you know, digging us into a deeper hole. But the recovery is an illusion. It's all built on a mountain of debt, and it's papered over by inflation. And when you talk about the dollar imploding, all currencies can go down simultaneously. It implodes relative to its absolute purchasing power. You need more dollars to buy oil. You need more dollars to buy food. But eventually, I think the dollar is going to lose a lot of value against other fiat currencies. You've got other currencies intervening now. They're trying to weaken their currency against the dollar. They're trying to prop the dollar up. Look at what's happening in New Zealand. Look what's happening in Norway. Look what's happening in Switzerland. And, of course, the yen wouldn't be weakening if the Japanese weren't talking it down. I mean, everybody is trying to weaken their currency to prop up the dollar. But eventually they're going to give up this foolish policy because the more money the world loans us, the deeper the problems get. They can't vendor finance us forever. Eventually they're going to have to stop doing it. And then the dollar is going to lose value even against other fiat currencies, even as all fiat currencies will lose value against gold based on this current race to the base.
Tom, your take on Peter's comments.
Well, look, as I said at the start, we're not saying everything in the garden is rosy, and the U.S. undoubtedly has some serious structural issues to address in terms of tax, of spending, and there doesn't seem to be an easy way through that. But, the economy is, for all of that, improving. You see that in factory output, you see that in hiring, you see that in business investment, and in that environment, whether Peter likes it or not, the number of large-scale investors like George Soros who feel they need to have a significant proportion of their money in tail-risk hedge assets like gold is diminishing.
All right, Tom, before I let you go, if gold is overvalued, as you say, then how far can it go? What's your price target for the end of the year?
Well, we don't specifically publish targets in that way, but when you're talking about where gold can go to in that kind of space of time, I think you have to remember that it was only 2 years ago that gold was trading at $1,400, and it was only at 5 years ago that it was at $650 an ounce. So, if we do see by the middle of this year the Fed scaling back its QE, as has been discussed, then I think you've got to consider where gold goes back to relative to what's been happening over the market over the last 3 or 4 years.
Okay, our thanks to Tom Kendall of Credit Suisse. Now, Jim, you heard Tom. You also heard Peter. Strong arguments on both sides. They're making a fundamental case here. Who's right? How are you trading gold?
Well, the part that Tom's right about is that our currency and our long end of our treasury curve at some point in time may become non-desirable for the rest of the world, but at this point in time there doesn't seem to be much of an alternative, particularly when you see 5, 6 other central banks more aggressively being combatants in this currency war. Now, mostly I agree with Peter, though, on the long-term trade of gold, and I think it's a great long-term investment, too. And I also think in the short term I like the trade as well, too. I think it's come too far too fast, and it's due for a little bit of a bounce. I'd be interested in buying gold at 1578, which is right where it is now. But this is a short-term trade. I'm looking for 1595 on the upside. If it goes down below 1566, I throw in the towel and think it has more room to correct. I do think in the greater scheme of things that what we're seeing over the last couple months is a correction.
Okay, but you still think at 1595, where you set your target there, you still think we're not going to get over 1600, even in this short bounce?
I think we could bounce around and have it be a rocky road. So I'm talking about a short-term time frame, and I don't think it'll have an easy time going over that right now. If you want to talk 6 months or a year from now, I think it'll take that out easily. But right now, I think it'll be a bumpy road. It probably has some more room on the downside. Probably about another $40 or so once it bounces higher. I do think it's going to bounce higher now, though.
Jackie, I'm starting to view gold as the Apple of commodities here. It had its run, it had a nice shine, but investors are looking for another thing. Look at the numbers coming out of China. Look what happened with Foxconn yesterday, where they're scaling back things there. That gold goes into cell phones that are being produced. So not only in the investor side, but the industrial side, it's kind of losing its luster too.
Yeah, no,
so,
I think it's the opposite. I mean, 2 things are going to happen. People are going to find out that the recovery isn't real, that it's not as strong as people think, that it's all a function of spending more borrowed money. And as we get weaker economic data, we got a lot of weak economic data that came out today. Look at the Philly Fed. Look at the unemployment numbers, the housing numbers. Look what's going on with these home building stocks. They're now all rolling over. So I think this has just been wishful thinking that the economy is recovering, that the housing market is recovering. It's not. That's going to mean the Fed is going to be more aggressive in its monetary easing, not less aggressive. So we're going to get more QE. The economy isn't weak. I do think ultimately stocks will reverse and go back up, but not because the economy is improving, because the Fed is debasing the money at an even faster rate. So I like your trade. I think people should trade gold, but I think you should be careful. Maybe you can turn this short-term trade into a long-term position. Don't cut your losses short, because I think there's far more upside in gold right now than there is downside.
Jim, final word to you.
Grizz, just one question to Grizz. Okay, let's say the Fed threw out a trial balloon yesterday and started talking tough about QE. If risk assets start to deteriorate hard, particularly housing stocks and the overall stock market in the next week, there's another Fed speech next week. What if all of a sudden they start backing off that and going to join in the currency war? Is gold going to skyrocket?
Hey, Jim, they could back off of it, but I think they're at the point where they're not going to back off of it. And in fact, I don't see the point where they're going to actually add more of it, too, because we've had 4 or 5 years of this, and the economy is marginally improved, and a lot of people will debate whether it's because of that or not. So I don't see them adding to the stimulus. I see them maybe subtracting stimulus down the road.
All right. A lot of different points of view. All eyes, of course, are going to be on the Fed, but let's go ahead and bottom line Jim's trade with the risk reward here. Jim is buying gold at $15.78. He's looking for a move up to $15.96. And remember that each $1 move in gold is worth $100. So this trade risking $1,200 to make a potential $1,700.